unpacking some of the real catalysts that exist in this stock and its valuation. But I want to do it on a pullback. These guys reported Q4 earnings earlier this week. I think in a lot of ways it was pretty well received by the new CEO, Marissa Mayer, but it's going to take a little time, and there's some things that have to happen for this thing to work. I want to wait until this stock pulls back, but I want to outline a trade structure in a name that I'm interested in getting long exposure in if we do get a pullback. I think this is the perfect time to do that, so you don't feel like you're just sitting on your hands. You're getting ready to do something if the market moves in your direction.
All right, so the strategy you're using is pretty complicated. It's called a call spread risk reversal. Good to crack open the playbook and break this one down. You sell a put, use that money to buy a call spread. We want the stock to go to that short call strike. That's where you make the most money. That's also where your profits are capped. And since we're also short a put, we must be willing to buy the stock. So, Dan, walk us through this trade.
All right, great. So, to me, I want to look out about 5 months here. I think there's some catalysts. I think there's some monetization of their Asian assets, which are really important. This company has about $5 of their market cap in cash, no debt. I think some analysts think that their Asian assets are worth maybe up to $15. You are getting their core business for free. They have this new CEO in place. She's going to start cutting costs. She's going to continue to buy back stock, and she's going to figure out a plan to fix search, display ads, and their mobile. And if she does all that, the stock could be really cheap. So what I want to do here, or what I'm looking to do on a pullback, I was looking at July expiration, okay? So I want to sell a put. And if I'm going to sell a put, I want to do it when the stock's ticking lower so I'm adequately compensated. So with the stock about 1965 when I price this up today, I could sell the July 18 put at 65 cents and use the proceeds to buy the July 2022 call spread for about the same price. That structure costs me nothing. So this is how the trade makes money. It's basically neutral on expiration, okay, between $18 and $20, okay, because I haven't paid anything for it. I can make up to $2 between 20 and 22. My max gain above 22 is $2. Now here's the thing. I'll put the stock at 18 on July expiration on a mark-to-market basis. If the stock starts moving lower, I'm going to show losses in my account on this thing. But at the end of the day, if I was going to buy this stock, let's say, lower than here, this is a decent structure. It gives you a really good risk reward, and I like it. I want to do it when the stock's a bit lower with vols up.
A quick question here.
Sure.
July. Why do you think July?
Okay, and that's a great point.
What are the catalysts?
I think Mayer, she's been under wraps here for a little bit. So this is her first quarter here, and I think she's going to get out on the tech conference circuit. She's speaking in Goldman Sachs in a couple of weeks. The company used to have an analyst day in May or June. I think if they do that, that's something people are getting excited about. And then there was rumors about an IPO for Alibaba, which they still have a considerable stake. And if that thing went well, here's something that I think could really explode the valuation on this stock.
Yeah. Mike, you a believer in the Yahoo story?
Well, I think, it's really interesting. I like this trade for a couple of reasons. One, a lot of smart value investors that I know have liked Yahoo for a long time, and it finally looks like it's rounding the bend. The second thing is, it's always hard to chase stocks. This one has obviously gotten a little bit of a boost. This helps take advantage of that. You're going to put the stock at a lower level. And finally, this trade also recognizes the fact that whether we believe it should be this way or not, volatility is low, and by selling those options, you're essentially not paying a whole lot of premium. So I like the trade.
All right, let's wrap this up a little stocks versus options here. Want to buy Yahoo as a late rally play. That will set you back almost 20 bucks a share. Worst case scenario in Dan's options trade, you could be forced to buy Yahoo stock for $18 a share, even if it falls below that level. But that does work out to about an 8% discount, so not bad there. Let's move on to our next option, and that is